Hi, I'm Todd Rosenbluth, Head of Research at VettaFi, and thanks for joining us for our latest episode of ETF360. I'm joined by Nick Childs of Janus Henderson ETFs because we're talking about JAAA. Nick, thanks for joining me.
Yeah, appreciate it, Todd. Thank you for having me.
It's my pleasure. So we're talking about the CLO space. Why do you think it's important for investors to be excited about this space?
The space has grown a ton over the last number of decades. It's now over $1 trillion in size. You compare that to the high yield market of 1.2 trillion in size. It's a real marketplace. And prior to JAAA, the product at hand here, there was no real way in which investors could allocate to the space. In fact, the investors that were allocating were your banks, your insurance companies, sovereign wealth. So having access to this more institutional product now, given its size and scale, makes a ton of sense for investors, particularly today.
Well, you talked about the size and scale, so let's dive a little bit deeper into it. JAAA or JAAA has been really popular in the past year. Why do you think it's resonating with investors?
Yeah, I think that's a great question. Well, for one, look, first mover advantage does not hurt, right? We really were the first real ETF, a real way in which investors could scale into the CLO product. So that didn't hurt. But then two, the Fed's raising rates at a level that we haven't seen in nearly 40 years, and the Fed's telling you to go get longer that front end part of the rate curve and de-risk. And look, these are AAA floating rate assets, effectively no duration or interest rate risk. And I mean, right now we're looking at yields of close to 7% for AAA asset. To me, compared to pretty much anything else through a risk-adjusted lens, seems pretty attractive.
So that's interesting. What do you think the biggest mistake investors are making right now?
I think the certainty of total returns and certainty of outcomes is incredibly dispersed. I also think tails in the marketplace haven't been this fat since the 2008 financial crisis. And so when I think about investor portfolios, really taking the income that the Fed is giving you, given what they're doing from interest rates, finding things that are high quality with the certainty in terms of outcome and total return makes a ton of sense. And you just don't need to take that much risk to get that today.
So we're talking about CLOs in particular with the ETF JAAA, but are there other areas of focus that you think investors should have?
Look, I think high quality fixed income is probably as cheap as it's been, relatively speaking, in some time, and that's a confluence of a number of things. But last year we had some of the largest outflows in fixed we've seen in decades. We had no overseas buying, given what was going on in the dollar, and we know what was going on with banks. Banks were not buying assets, so high quality fixed from a risk adjusted perspective is as cheap as it's been. The other things I look for is what is the Fed inadvertently affecting, given what they're doing around raising rates as well as quantitative tightening. Agency mortgages stick out incredibly well in that environment, given quantitative tightening, given kind of where spreads are. Look, we haven't seen these government guaranteed assets as cheap as they've been since 2008. And lastly, these assets are really well positioned from a macro perspective. So they prefer a re-steepening of the yield curve. They prefer lower interest rate volatility. And from a fundamental perspective, the risk here is really refinancing behavior. Look, we have mortgage rates over 6% with average prevailing rates of 3%. We're so far away from a refi event that option looks really cheap to us.
Well, Nick, I appreciate the insight. Thanks for sharing it with the audience, and thank you to everybody for tuning in.
Yeah, appreciate it, Todd. Thanks a lot for having me.
My pleasure. Have a great day.